Hey everyone, welcome to the channel. My name is Ash Anderson, and today we're going to be talking about Tech Breakdowns 8 rules for finding high quality tech stocks. So anybody that's watched this channel for a long time knows that I love scoring things. I love putting rules around things. I once had the Buffett score, I've had the analyst score, I've had a whole bunch of scores that I've built over time. The Tech Breakdown score is no different. This one looks for high quality tech stocks. So not exactly, you're not going to find a Rocket Lab in here. You're not going to find those high-flying 1,500% gainers over a couple of months in here. You are going to get the names that we expect bubble to the top, the likes of NVIDIA, Google, Microsoft. But also, there's 75 other stocks that got this A grade, and those are the names that I like to make sure the portfolio is padded with. Because if the market were to collapse, the high growth names, again, like a Rocket Lab, an ASTS, a Robinhood, these high growth names, those will collapse 30, 40, 50% in probably a few days, if not a few weeks. And that can be really scary. So I do like to make sure that my portfolio, my tech portfolio, is padded with some high quality names that still have potential as well. And that is your likes of NVIDIAs, your Googles, your Microsofts, your Apples, those types of companies. So I use these 8 criteria to figure out, okay, what are these high quality names? Let me do a deeper dive. Let me see if it's worth adding to the portfolio. Now, the cool thing is a lot of this I used to do by hand, right? Some of the rules that I've always followed have been quantitative, which means I can use services like Financial Modeling Prep, which is an API. If you haven't used it or checked it out, go check it out. It's relatively inexpensive, a good quality data source for lots of the side projects that I do. But that's quantitative. Qualitative was always hard to do because you would have to open up a Microsoft and ask the question and then figure out the answer. But with AI and with AI APIs and LLMs and all this other cool stuff, we can now automate a lot of that qualitative rule discovery and rule grading. The thing is it can be expensive as well. It can be time consuming. It can be oftentimes incorrect. But because this is a score where I'm trying to at least just figure out some direction, figure out what to look at, I've decided to use these LLMs to run against 500 plus stocks and figure out, hey, qualitatively, which of these stocks make sense. And so that's what we're taking a look at today is the 8 rules, what they are, and we're going to use them to compare Snowflake and Datadog, two complete, SaaS darlings over the last decade or so. We're going to compare Snowflake and Datadog across these 8 rules just to show you how they all pan out, and then show you what the grades are for these companies at the end. The first rule I always look for is a company founder-led? There's been videos on this channel, there's been posts on Tech Breakdowns over time that have spoken about founder-led companies and why I prefer them. And it's clear, right, when you watch any of these videos, you'll hear me say Rocket Lab and Robinhood. These are companies that I love, that I've made good gains in, and they are both founder-led companies. Founder-led tends to lead to outsized performances from what I've seen, and also from what a study by Bain and Company uncovered. So founder-led is a good alpha finding mechanism, so I do like to check that one first. Snowflake, not founder-led, fails this score. Datadog is still founder-led, still a founder as its CEO, and so that one passes the score. A second rule I look for is the company the primary competitor, the primary company in the market where it competes? To pass this, you just need to be number 1, number 2, or a very close third in the category. Datadog is by far number 1 in observability. There's other companies like Dynatrace that are there as well, but Datadog is by far the number 1 choice when it comes to this. New Relic is another one, but still, Datadog, number 1, it gets a pass. Snowflake gets a fail here because its bigger competitors are AWS and Google Cloud. AWS has Redshift, which is the most dominant data aggregator for large enterprises, and then Google has BigQuery, which is second place. Snowflake is massive, right? It has 17% of the market, but it is competing against 2 of the biggest whales in technology, and those big whales have bigger products. So we fail it on that score. Rule number 3 is stock-based compensation discipline. So high-quality companies are not diluting their shareholders massively, which is why I look for this, right? Snowflake is a massive diluter of investors. For every $1 in revenue Snowflake brings in, 37 cents of that goes to its employees via stock-based compensation. So yes, the employees are getting paid, but as an investor, that's not beneficial to growth in the stock. 37% is just insane for a company of Snowflake's size. Obviously, over time, they're going to get that under control, but for right now, this is a fail, and it's something that I would avoid because it's scary to see that much going out the door. I should mention the passing criteria is less than 20%. So 20% is still a massive number. Passing criteria less than 20, Snowflake does not even come close. And Datadog is a little bit of a hair above that 20%, so it also fails this rule. I think 22% of its revenues go out as stock-based compensation. Still very, very high, but a lot better than Snowflake's. Rule number 4 is called data gravity, and I've got the scoring criteria here because I don't want to mess it up and fumble it, but what we're looking for is does the company have a strong data moat? So there's a couple of ways of looking at this, but one way I like to look at it is the way that Peter Thiel described it. So Peter Thiel, famous venture investor, he always looks at it as like a monopoly test, right? Or a network effects test. He said if the 1,000th customer added benefits the previous 999, right? Does the product get better as you add a new customer? If that 1,000th customer makes the product even better for the other 999, that's a pass. And so I've got it broken down. This one is a score. It's from 0 to 10. Those low scores being no data moat, easily replaceable. So, it's not learning from anything. 3 to 4 is weak. It's mostly a tool, but the data is portable. 5 to 6 being moderate, some accumulated value, but it's not core to the business. 7 to 8 is data stickiness. 9 to 10 is a strong data moat, that very clear network effects. And so 10 is pretty much unheard of. I keep that for rare occasions, but in this case we got a 9 for Snowflake. This is their strongest moat. Petabytes of data, the gravity right is immense. There's also this Snowflake marketplace, which makes it better for all the previous customers. So if you are a customer of Snowflake and you have, let's say, a very particular set of, looking at my bookshelf, right? You've got a set of data on books that nobody else has. You can put your book data set into the Snowflake marketplace. You can charge money for that. That keeps people, it's stickiness in the data, right? Because now that book's data is only available on Snowflake because I provided it. Anybody that wants to use it has to be on Snowflake. And books is probably a terrible example, but you can get the idea, right? Weather or commodity prices, all sorts of stuff like that. There's data sets for it. And Datadog, I give it an 8 out of 10 to on this data stickiness. While it's not exactly like Snowflake, it does hold the history of every error, every issue, every thing that has gone wrong with an application, and a business relies on that data to make good decisions going forward and to make good decisions about how to build, monitor, and maintain a product. So Datadog does have some data stickiness there as well, and that gets an 8 out of 10. But Snowflake wins this round. So the next one, this one is just a low, medium, or high. So basically a 1, 2, or 3 on the scoring scale, which is switching costs. It plays a lot into that last data question as well, but there are other things that go into switching costs. What we're looking for is, should I decide tomorrow I don't want to use this product, how hard will it be for me to get off that product? For Snowflake, the answer is high. That's because it is tied into many or a lot of business workflows at companies that it is embedded in. So if you are using Snowflake, you send all your data to it. You have reports, you probably have tools, you have a lot of stuff that is built now around Snowflake. And so you don't want to lose access to Snowflake, and doing so would be a months-long migration, right? If you were to go from Snowflake to Redshift or to BigQuery, and you were to port everything over to AWS or to Google, that would take many months and lots of months in rebuilding all those reports. So this gets a high, which is the best score you can get. And Datadog as well gets a high because similar reasons, right? Companies have built all their stuff around Datadog. It is monitoring all of their technology. They've built reports, they've built workflows, they've built tools, they've built mechanisms all around Datadog as that central monitoring and monitoring tool of the business. And so to rip Datadog out, sure, you can do it, and I've worked at companies where we have taken Datadog out and replaced it with something else, but it is a many months long project. You can't just walk in on a Thursday, rip it out, and be on something new even by Monday, right? It's not a weekend project. This is a very long-lived project for an enterprise, so Datadog also gets a high on switching costs. Rule 6 is pricing power. So this is easy for SaaS companies because what they publish is like a net retention rate, which is for every $1 I took in this year. So if I was a Snowflake customer and I pay $1,000 a year to Snowflake, which is very low, unheard of, but I pay $1,000 a year to Snowflake. Net dollar retention or net retention rate is the measure of how much I pay them next year. So if I pay them $1,000 this year and next year I pay them $900, that's not good, right? They're losing 10% for a customer like me. They don't want to be in that position. Now, luckily for Snowflake, they're not. For every $1,000 a customer gives Snowflake this year, they give them $1,250 the next year. They have a whopping $125% net dollar retention rate, which is a really high number. Right? That's $1,000 to $1,250. There are companies that are spending $100,000, $1 million, and they're adding 25% on average year over year. So that is exceptional pricing power from Snowflake. Datadog is in a similar boat, although not quite as high. Every $1,000 for Datadog, it's 115%, so that's $1,150 the next year. These numbers will come down over time, of course, because you can't just keep tacking on 25 and 15% to your customers every year and expect to get away with it. But over time, you know, there's some good compounding there for these businesses. Rule 7 is a fully quantitative rule, but I needed to keep it around. It is the rule of 40. So rule of 40 is you take the revenue growth rate. So what is this year's revenue? What is last year's? If you've gone up by 10%, 10%. You take your revenue growth rate and you add to it the free cash flow margin. For both, you know, if your free cash flow margin is 35%, your revenue growth is 10. Cool, 45 you pass. If it's 25% and 10, 35% you fail. So Snowflake is growing at 29% with an 18% free cash flow margin. That's above 40. Datadog is growing a little bit slower at 26%, but has much fatter free cash flow margins at 29%. So that one also passes. But there's no benefit, right? Or there's no benefit to the score from being at a rule of 40 score of 300 versus 40. It's still a pass fail. If you're at 300, if you're at 40, you pass. Then rule 8 is R&D, research and development efficiency. So there are a couple of ways to go about this, but it is qualitative, as I explained. So I'm going to read again from my notes because I have a few rules, and this is what I tell the LLM to follow when it's looking through the whole list of companies, right? R&D efficiency, you're going to pass if your revenue growth is higher than your R&D percentage of revenue as a percent of revenue. That means you're very efficient, right? Your revenue growth is growing faster than your spending on research and development. If you have high growth with reasonable R&D spend as well, and that's obviously very fudgy, but if you are growing your revenue at 10% and spending 30% on R&D, not good. If you're spending 30% on R&D and growing at 29%, sure, that's good, right? Maybe there's going to be some downstream effects there. And then a clear product innovation pipeline. So this one, obviously, it is an LLM. It's using web search. If there is a clear product innovation pipeline that's outlined somewhere out there, it brings it back. And so for all these rules as well, I do have the LLM providing like the rationale for the outcome, and you can find that on the Tech Breakdowns website. There'll be a data file for any free newsletter subscribers. You get the latest and why it gave it that particular score in there. But for this rule, Snowflake does fail because it spends 40% of its revenue on R&D, and as we just talked about, right, the growth is under 30%, 28% as of the time of recording. So that 28% growth, 40% R&D. It's really not looking positive. It may at some point, but for now, it is unreasonable R&D spending as a percent of revenue. The Datadog is still spending a lot as well at 29%, but with the 26% growth, this is really close. They're also coming out with a lot of new products. Like they've got cloud security and LLM observability that have recently been added. So there are future growth products that are clearly coming from this R&D spending, and it is in line with the revenue growth as well, 26% revenue growth, 29% R&D spend, so it does get a pass on this one. Yeah, let's sum it all up, right? Datadog is an A-rated stock as per these 8 criteria. That is a company that I would look to do a further deep dive on and probably add to the quality component of my tech portfolio. Snowflake actually gets a D rating, and Ds aren't all bad, right? There are some Ds, I was just looking, right? There's some Ds that have gone up 1,000+% over the past few months, but one of those that I wouldn't choose to add to the quality part of the portfolio is one that maybe I would go back and look at, like the venture part, the high growth part. I don't think that Snowflake fits that bill either. So this is a name that I would just push to the side and ignore. You might hold it. That's great. There's no knock on your holding. It just doesn't follow the rules that I've outlined for the Tech Breakdown score. But yeah, if you want to see the whole list of stocks, the whole list of any stock that's in the technology sector, it is available for free on techbreakdowns.com. You just have to sign up for the newsletter and you'll be able to download it right away. But that data, right, is best to be used from a very high level. just to look about and say, hey, I'm interested in buying some high quality tech. What is high quality right now? Scan that list, look at those A's and B's. Those are going to be your high quality names. Your D's and your F's, they stand a chance of returning significant amounts, but they're generally not high quality, which is why they don't pass this score and don't fit in the high quality part of this of my tech portfolio. Now, I am also working on right now refining the final requirements of that more venture score, of that more high growth score. And so we'll be taking a look at that in a future video. So if you are interested, do subscribe. I'd also love it if you left a comment what you think to these different rules, different ratings, that sort of stuff. Leave a comment below and let me know. But thank you so much for watching. I hope you enjoyed it, and I will see you next time. Have a good one.